Section 1:1 Introduction to Alpha, Definition and Concept of Alpha. Alpha is a measure of investment performance that evaluates the excess return of an investment or portfolio relative to a benchmark. It is used to determine the skill or ability of a portfolio manager in generating returns above what would be expected based on the level of risk taken. In the context of investments, a benchmark is a standard against which the performance of an investment can be compared. It is typically a market index or a similar representative measure of a particular market or asset class. Alpha measures the value added or subtracted by a portfolio manager's investment decisions, taking into account the risk associated with those decisions. It is often considered a measure of a manager's ability to generate returns independent of market movements. Positive alpha indicates that the investment or portfolio has outperformed the benchmark, while negative alpha suggests underperformance. A positive alpha implies that the portfolio manager has made investment decisions that resulted in higher returns than what would be expected based on the level of risk. Conversely, a negative alpha suggests that the investment performed worse than the benchmark, considering the level of risk involved. It's important to note that alpha is not the sole measure of investment performance, and it should be interpreted in conjunction with other metrics such as beta, a measure of the investment sensitivity to market movements, and standard deviation, a measure of risk. Additionally, alpha can be influenced by various factors such as market conditions, investment strategy, and the time period considered, so it should be used with caution when assessing investment performance. Alpha and beta are both measures used in finance to assess investment performance, but they represent different aspects of an investment's risk and return characteristics. Alpha measures the excess return of an investment or portfolio relative to a benchmark, after adjusting for the risk taken. It is often considered a measure of a portfolio manager's skill in generating returns independent of market movements. Positive alpha indicates outperformance, while negative alpha suggests underperformance. Alpha can be influenced by factors such as stock selection, timing of trades, and other active investment decisions. Beta measures the sensitivity of an investment's returns to movements in the overall market or a benchmark. It indicates the degree to which an investment's price tends to move in relation to the broader market. A beta of 1 means the investment tends to move in line with the market, while a beta greater than 1 indicates higher volatility, and a beta less than 1 suggests lower volatility. Beta helps assess the systematic risk of an investment, i.e., the risk that cannot be diversified away. It is a useful measure for investors to understand how an investment may perform in relation to market movements. In summary, while alpha measures the excess return generated by a portfolio manager above or below a benchmark, beta measures the volatility and sensitivity of an investment's returns to market movements. Alpha is often associated with active management and stock selection skill, while beta represents the systematic risk inherent in an investment. Both measures provide valuable insights into investment performance and risk, and they are often used together to evaluate investment strategies.